Reporting results. LOSO. Identify and explain common financial performance measures, ROI, EPS, EVA, operating cash flow. Return on investment, ROI, measures profitability relative to invested capital and is calculated as operating income divided by total assets or invested capital. It evaluates how efficiently management uses resources to generate earnings. ROI facilitates comparisons across divisions and competitors but must be interpreted alongside risk and capital intensity considerations. Earnings per share, EPS, represents net income available to common shareholders divided by the weighted average shares outstanding. It reflects shareholder profitability and is widely used in capital markets, influencing stock prices and investor perceptions. Economic value added, EVA, measures residual income after deducting the cost of capital from operating profits. Operating cash flow evaluates the firm's ability to generate cash from core operations, indicating liquidity and financial sustainability beyond accounting profits. LOSP. Identify and explain problems with ROI, EPS, and EVA. ROI may discourage managers from investing in projects that earn above the cost of capital but below the division's current ROI, leading to underinvestment. It can also incentivize short-term decision-making and asset reductions rather than long-term value creation. EPS can be manipulated through accounting policies, share repurchases, or leverage changes without improving underlying economic performance. It does not account for the cost of capital or risk, potentially misrepresenting true value creation. Although EVA incorporates cost of capital, it may be complex to calculate and dependent on numerous accounting adjustments. All three measures risk distorting behavior if not aligned with long-term strategic objectives. LOSQ. Demonstrate understanding of the DuPont formula and use it to analyze performance. The DuPont formula decomposes return on equity, ROE, into three components: profit margin, asset turnover, and financial leverage. ROE equals net profit margin times asset turnover times equity multiplier. This breakdown provides insight into whether performance improvements stem from operational efficiency, asset utilization, or leverage. By separating profitability and efficiency drivers, DuPont analysis allows managers to identify strengths and weaknesses relative to competitors within the same industry. For example, a firm may have lower margins but superior asset turnover. Comparative DuPont analysis enhances strategic evaluation by linking financial outcomes to operational and financing decisions. It supports informed recommendations to improve margins, optimize assets, or adjust capital structure. LOSR. Explain issues in determining product, business unit, and customer profitability. Determining product profitability requires accurate cost measurement and allocation. Challenges include assigning indirect costs, selecting appropriate cost drivers, and distinguishing between fixed and variable costs. Inaccurate allocation may overstate or understate product performance, leading to poor strategic decisions. Business unit profitability analysis involves evaluating revenue recognition, capital investment measurement, and shared cost allocation. Transfer pricing policies and corporate overhead distribution can significantly affect reported performance. Customer profitability requires tracking revenues, service costs, discounts, and returns. Allocation of marketing and support costs is complex. Misclassification of costs or timing issues may distort profitability analysis, affecting pricing, segmentation, and retention strategies. LOS. Analyze and evaluate customers, products, and strategic business units based on profitability. Evaluating customer, product, and strategic business unit (SBU) profitability requires analyzing revenues, direct costs, allocated overhead, and capital usage. For customers, this includes assessing lifetime value, servicing costs, discounts, and retention rates. For products, contribution margins and fixed cost absorption must be carefully measured to determine whether offerings truly add economic value. For SBUs, profitability analysis extends beyond income statements to include invested capital, asset utilization, and risk exposure. Performance should be compared to strategic objectives and industry benchmarks to assess competitive positioning. Effective evaluation distinguishes between short-term accounting profits and long-term economic contribution. Recommendations may include repricing, restructuring, cost reallocation, divestment, or increased investment in high-performing segments aligned with strategy. LOS-T. Define residual income, RI, and describe its advantages compared to other measures. Residual income, RI, is defined as operating income minus a charge for the cost of capital employed, RI equals operating income minus invested capital times required rate of return. It measures the absolute dollar amount of value created above the minimum required return, aligning managerial performance with shareholder wealth creation. Unlike ROI, which is a percentage measure, RI encourages managers to accept any project that generates returns above the cost of capital, even if it lowers average ROI. This reduces underinvestment problems associated with ROI-based evaluation. RI also directly incorporates cost of capital, providing a clearer measure of economic profit than EPS. It better aligns divisional decisions with enterprise-wide value maximization objectives. LOSU. Analyze and interpret ROI calculations and compare them to RI calculations. Return on investment, ROI, measures relative profitability as a percentage of invested capital, enabling comparisons across divisions or firms. However, managers may reject profitable projects if the project's ROI is below the current divisional average, even if it exceeds the cost of capital. In contrast, residual income, RI, focuses on absolute value creation and encourages acceptance of all positive net present value projects. A project that reduces ROI but increases RI still adds shareholder value and should be undertaken. When comparing ROI and RI results, analysts must determine whether decisions support long-term economic performance. RI is generally superior for strategic alignment, while ROI remains useful for benchmarking operational efficiency within industries. LOSV. Identify and analyze other financial ratios used to evaluate performance. Liquidity ratios, such as the current ratio and quick ratio, assess a firm's ability to meet short-term obligations. Strong liquidity indicates operational stability and lower default risk. Leverage ratios, including debt-to-equity and interest coverage, measure financial risk and capital structure sustainability. Activity ratios, such as inventory turnover and receivables turnover, evaluate asset utilization efficiency. Higher turnover generally reflects effective working capital management and operational strength. Profitability ratios, including gross margin, net margin, ROA, and ROE, measure earnings performance. Market ratios, such as price-to-earnings, PE, and market-to-book ratios, reflect investor expectations. Together, these ratios provide a comprehensive financial performance assessment.